Before we get into what the data is actually saying right now, real-time reads go there first. Not for everyone, just the ones who want to be early. Now, let's talk about what February 25th, 2026 actually looks like when you strip the narrative away and read the numbers directly. Bitcoin is sitting at $65,420 as of today. Today's open was $64,068. High was $66,313. Low was $63,912. That is a $2,400 range in a single session, up 2.12% on the day. Write that down not because it's exciting, but because of what preceded it. January 27th, Bitcoin was at $8,917. That was 29 days ago. Today, it is $65,426. That is a 27% decline in 29 days. And if you go back further, October 2025, all-time high of $126,000. The drawdown from peak to today is 48%, nearly half, in 4 months. Now here's the number that most channels will not show you cleanly. February 5th. Bitcoin hit $62,091 and dropped 13.98% in a single day. That was the largest single-day move in this entire correction. The following day, February 6th, it bounced 12.33% to $70,127. That two-day sequence, a 13.98% crash followed immediately by a 12.33% recovery, is not random price action. That is a structure. And structures tell you something about who was in the market and what they were doing. We will come back to February 6th, because what happened on-chain that day is the most important data point in this entire video. First, the exchange picture, because this is where most people are getting the story backwards. CryptoQuant is showing total exchange reserves at approximately 3.02 million Bitcoin right now. Binance alone is sitting at 673,600 BTC, a 15-month high. Let me be direct about what that number means. When Bitcoin moves onto exchanges, it is being positioned for sale. High exchange reserves mean sell pressure is present. That is not a bullish signal in isolation. That is real. I am not going to spin that number. But here's what you hold alongside it. Glassnode illiquid supply as of February 22nd sits at 13,479,866 Bitcoin. That is 67.4% of total circulating supply sitting in wallets that historically demonstrate near zero spending behavior. Long-term holders, cold storage, institutional custody, people and entities who have been through every crash, every Bitcoin is dead headline, every FTX moment, and did not move, not once. Two numbers. 3.02 million Bitcoin on exchanges available to sell. 13.48 million Bitcoin in a liquid storage that is not moving. The ratio tells you the actual supply picture more accurately than any headline. Now the MVRV ratio. Currently at 1.1. That means Bitcoin's market price is sitting only 10% above the average cost basis of every holder in the market. When MVRV approaches 1.0, when market price equals realized price, that has historically marked Bitcoin's absolute cycle floors. 2018 bottom. 2020 COVID crash, 2022 FTX collapse. Every time MVRV dropped to this territory, the people who understood what the number meant and did not sell came out the other side with significant unrealized gains. We are not below 1.0 yet. CryptoQuant identifies $55,000 as the realized price floor, the level where MVRV hits 1.0 in this cycle. That level has never been broken for long in any previous cycle. Verify that yourself on CryptoQuant. Now February 6th, because this is the data point that changes the conversation. On February 6th, the day after the biggest single-day crash of this correction, on-chain accumulation addresses absorbed 66,940 Bitcoin in a single day. That is $3.6 billion at current prices moved into accumulation wallets in 24 hours. According to TradingView and Cointelegraph data, that was the largest single-day whale accumulation event of this entire cycle. Not this week. This entire cycle. And it happened on the exact day that looked like maximum destruction. Zoom out to the last 30 days. Wallets holding more than 1,000 Bitcoin have accumulated approximately 98,000 BTC over that period. Last week alone, that same cohort accumulated approximately 53,000 coins. No press release, no social media post, no announcement. The blockchain is public, the transactions are on-chain, permanent, immutable. They happened. There is also a negative signal worth stating clearly. Some whale wallets shed approximately 43,000 BTC recently. Mixed signals are real. I am not presenting a one-sided case. What I am saying is that the net accumulation picture over 30 days, 98,000 BTC into large wallets, is a structural data point that deserves your attention separate from whatever the price chart looks like on any given day. Now the ETF picture. Because the media gave you the headline without the context. 6 consecutive weeks of net outflows, $4.5 billion pulled out year to date, $3.8 billion over the last 5 weeks specifically. Monday, February 23rd alone saw $203.8 million in outflows. That is real. That is what the data shows. Here is what the same data also shows. Despite 6 straight weeks of outflows, Spot Bitcoin ETFs collectively still hold approximately $85 billion in assets. BlackRock's IBIT alone holds 755,315 Bitcoin as of February 24th, roughly $54 billion in AUM. These products absorbed $4.5 billion in redemptions and are still holding 60 times that amount in assets. That is not collapse. That is durability under pressure. And then today, February 25th, after 6 consecutive weeks of outflows, ETFs recorded $258 million in net inflows in a single session. One session does not make a trend, I will say that clearly. But 6 weeks of consistent outflow reversing, even for one day, is a data point worth tracking. The 5-week outflow waterfall at minimum paused. Whether it reverses and sustains is the question the next 2 weeks will answer. The 71 institutions that filed official 13F disclosures representing $18.37 billion in Bitcoin positions do not make decisions based on a week of bad headlines. They make decisions based on mandate, allocation models, and risk frameworks that operate on timelines retail traders do not think about. Now the derivatives picture. Because this is where the short-term mechanical pressure is concentrated, open interest has fallen from approximately $61 billion 1 week ago to somewhere between $34 and $49 billion today. That is a 20 to 28% decline in open interest in 7 days. Over the past 30 days, the decline is larger. VanEck research published this week identifies this as one of the most significant deleveraging events in Bitcoin's derivatives market in nearly 3 years. Every overleveraged long position has been destroyed. Every reckless short-term speculative position liquidated. On February 23rd, a single whale long position on HTX was liquidated for $61.5 million. Total crypto liquidations on that day reached $468 million. On February 24th, when Bitcoin broke back above $66,000, short liquidations reached $1.593 billion in 24 hours. That number, $1.593 billion in short liquidations in one day, tells you something specific. There was an enormous amount of capital positioned against Bitcoin at these levels, and that capital got destroyed when price moved. Now the funding rate, currently negative at approximately 0.022% on February 23rd. Negative funding means short sellers are so numerous and so crowded that they are literally paying the people on the other side just to hold their positions. The short sellers are paying to stay short. The last time funding rates were this negative at these MVRV levels was the 2024 cycle bottom. That is not a prediction, that is a historical comparison. Verify it on any derivatives data platform. The mechanical implication is straightforward. If Bitcoin trades above $70,000 and holds there, the negative funding and crowded short positioning creates conditions for a short squeeze. Cointelegraph published analysis this week explicitly identifying $70,000 as the level where short squeeze mechanics become relevant. $864 million in short positions would face forced liquidation above that level, according to CoinLast data. That is not a price target. That is a mechanical threshold in the current positioning structure. Now the mining picture. Because miners have skin in the game that no analyst, no ETF manager, and no retail holder has. February 7th, mining difficulty dropped 11.16%. February 19th, it increased 14.73%, bringing total difficulty to 144.4 trillion. That 14.73% single period increase is one of the largest difficulty adjustments in recent history. Mining difficulty only increases when more machines are being added to the network. More machines means more capital deployed. You do not spend millions of dollars on ASIC hardware, electricity contracts, and cooling infrastructure if you believe the asset you are mining is heading to zero. That is not how capital allocation works. Public mining companies have sold approximately 5,359 BTC recently under winter power cost pressure. Their collective holdings dropped 4.44% in 1 month. That selling pressure is real, and it is part of why price has struggled. But CoinDesk published analysis this week with a specific headline worth reading directly. Quote, "One of the longest mining capitulations nears end, signaling potential BTC price bottom." Unquote. That is not my analysis. That is CoinDesk's read of the current mining data. Verify it yourself. Now the regulatory picture, because 2 things happened this week that have opposite implications. The Clarity Act, the digital asset regulatory framework bill that prediction markets had at 80 to 85% passage probability, has stalled in the Senate. Industry support withdrew. The timeline that many analysts were pricing into their Bitcoin forecasts has been pushed back. That is a real negative development for the institutional adoption narrative in the short term. Simultaneously, CME Group, the world's largest derivatives marketplace, announced this week that starting May 29, 2026, they will launch 24-hour, 7-day-a-week Bitcoin futures and options trading. Currently, CME operates Monday through Friday during regular market hours. Every weekend, there is a gap in institutional hedging infrastructure. Price can move Saturday and Sunday without full institutional participation. That gap creates the trading anomalies known as CME gaps. Weekend price movements the market sometimes returns to fill during the week. When CME goes 24/7, that entire dynamic changes. Bitcoin becomes a fully institutionalized, around-the-clock financial instrument with the same market access as gold futures, oil futures, and equity index products. Infrastructure drives capital over time. This announcement matters on a longer timeline than any weekly price move. Trump Media acquired $2 billion in Bitcoin. Strategy's total holdings now sit at 712,647 Bitcoin after their January purchase of 25,240 BTC. These are not small entities making speculative bets. These are public companies with shareholders, boards, and legal obligations making deliberate multi-billion-dollar allocation decisions at current prices. Now, sentiment, because this is where the data gets genuinely interesting if you understand how to read it. Fear and greed index today is sitting between 10 and 14, extreme fear. It has been in this zone for multiple weeks. The yearly low was recorded on February 5th, the same day as the largest single-day price crash of this correction. Google Trends searches for the phrase Bitcoin going to zero have reached their highest level since the FTX collapse of November 2022. The phrase "is Bitcoin dead" is at multi-year search highs. Overall, crypto search interest is at one-year lows. Here's what that data has historically meant. November 2022, FTX collapsed. Bitcoin to zero searches peaked at 100 out of 100 on Google Trends, the maximum possible reading. Bitcoin was at $15,500. The people who sold at that exact moment of maximum search volume missed Bitcoin going to $48,000 by January 2024, to $73,000 by March 2024, to $126,000 by October 2025, an 800% gain in under 3 years for doing nothing except not selling at the moment of maximum fear. March 2020, COVID crashed global markets. Bitcoin fell 50% in 2 days. Bitcoin is dead searches spiked. 12 months later, Bitcoin was at $55,000. The structure recovered faster than the sentiment did. Today, Bitcoin to zero Google searches are matching November 2022 FTX levels exactly. That is the data. What you do with that comparison is your decision. Now, the honest case for caution, because this is what separates analysis from promotion. Exchange reserves at 3.02 million Bitcoin and rising is a real sell pressure signal. 6 consecutive weeks of ETF outflows totaling $4.5 billion is real institutional de-risking. The Clarity Act stalling removes a near-term institutional catalyst. Prediction markets are showing 61% probability of Bitcoin testing $50,000 before any significant recovery. CryptoQuant identifies $55,000 as the realized price floor, and that level has not yet been tested in this cycle. The macro environment with tariff uncertainty and equity market correlation adds risk that did not exist at previous cycle bottoms at this MVRV level. Humphrey Neal wrote in Tape Reading and Market Tactics that the tape tells you what is happening, not when it finishes happening. The structural story is written in the data. The timeline is written by the market on its own schedule. Here is what the data is actually saying as of February 25, 2026, separate from what you want it to say. Bitcoin spot at 65,426, 48% below October 2025 all-time high. Exchange reserves at 15-month highs indicating sell pressure is present. Illiquid supply at 13.48 million Bitcoin, 67.4% of circulating supply not moving. MVRV at 1.1, approaching the historical accumulation floor. Whale wallets accumulated 98,000 BTC over 30 days, with the single largest daily accumulation event of this cycle occurring on February 6th. ETF outflows totaling $4.5 billion YTD, while $85 billion in assets remains in these products. Open interest down 20 to 28% in 7 days. Significant deleveraging has occurred. Funding rates negative. Short sellers are crowded and paying to stay short. $61.5 million whale liquidated February 23rd. $1.593 billion in short liquidations on February 24th. Mining difficulty increased 14.73% on February 19th, despite price being 48% below ATH. Fear and greed at extreme fear reading of 10 to 14. Google searches for Bitcoin going to zero at FTX era highs. Clarity Act stalled. CME launching 24/7 trading May 29th. Strategy holding 712,647 Bitcoin. Trump Media acquired $2 billion in BTC. The paper price and the structural data are telling different stories right now. They have been telling different stories for weeks. At some point that gap resolves. Whether it resolves this week, this month, or over a longer time frame, that is the open question. What is not open is the direction of the structural accumulation pressure underneath current price. Verify the CryptoQuant exchange reserve data. Check the Glassnode illiquid supply numbers. Look at the February 6th on-chain accumulation figure. Read the CoinDesk mining capitulation analysis. Check the CME announcement directly. And when you do, separate what the data is actually saying from what you want it to say. That distinction is where most people lose money. Not because they read the wrong data, because they read the right data through the wrong lens. This is market structure education, not advice. Manage your risk, protect your capital. The ones who read the data clearly and stay disciplined when the market gets loud, those are the ones still standing when the structure resolves. Drop 3 words in the comments if you are reading the structure the same way I am. That is how I know who is actually here and paying attention. Do your own due diligence. Out.